Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The Fed is going to have to probably pump the brakes. Although they're going to cut tomorrow, their forward guidance is going to have to get adjusted. So they're probably going to have to take out a cut or possibly two cuts from their 2025 projection.
I think the consumer in general right now is still doing fairly well. That always has to be sort of adapted in the U.S. to understand that different segments of the consumer will be doing differently well than others. I think all shoppers are being deal sensitive. They're being thoughtful and cautious about what they spend, but that overall the consumer is in pretty good shape.
They currently have no hybrid vehicles available on the marketplace. Hybrid vehicles are the fastest growing segment of the auto market in the U.S. And so while they've had some success with their EVs, we think the federal EV tax credit will be going away. That's going to really hurt their EV sales. We see an environment in 2025 where GM actually loses market share to some of their competitors.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We've got a downdraft happening today, Josh. Yesterday was mixed. We saw the Nasdaq hit a new record high, not so today, and the Dow is down again. It's been on a losing streak here. If you pull back and look at 10 days here, you've seen this streak down, I believe, for 8 of the last 10 sessions. Today, down about 364 points, 0.8%. The S&P off by a little more than 0.5%, and the Nasdaq down 0.4% here.
Did get some important economic data today. Got retail sales solid, right? You saw October revised higher. There were some weak spots, right? Some soft patches. Food services sales, for example, not so great. But overall, Julie, economists, I think, were telling their clients, they looked at that and their takeaway was consumers are not throwing in the towel. I mean, you look at that report, that suggests people keep spending.
Yeah, and we got industrial production too. It declined for the third month in a row, but not hugely surprising. There are nothing in those economic reports today that really seem to change the calculus on what the Fed is going to do. We got the Fed decision tomorrow at long last. Broad expectations that we're going to get a quarter-point cut. Right now, the 10-year yield down just a basis point, say 4.38%. If you look, let's look at the 1 month here, and we've kind of seen a round trip, not a heck of a lot of movement there, as we have seen relative steadiness for this cut. Of course, the question is what then happens going into next year.
Yeah, that's the question is, do they cut and then Jay Powell takes the mic and starts preparing you for a pause early next year?
Yeah, and there's one more thing I want to check on if I can scroll down to it. Where is it? There it is. It's Bitcoin. Bitcoin once again seeing some gains. There's the 1 month chart, but above 106,000 per Bitcoin.
Which we will be talking about later in the show. All right, for more on the latest market moves, let's now welcome in Savita Subramanian, BofA Securities Head of U.S. Equity Strategy and U.S. Quantitative Strategy. Savita, always good to see you and have you on the show. So listen, we're wrapping up 2024, Savita. Great year for the bulls. As we look ahead now to 2025, you're telling your clients, you know what? You're pretty positive. Your year-end target, I know for 2025, Savita, implies about 11% upside. Why the optimism, Savita, especially with valuations where they are?
Yeah, valuations are the critical bear case that we hear from almost every investor we talk to, and there's so many cheaper indices besides the S&P 500 or the Nasdaq. Look, I think the valuations are kind of interesting right now because when you look at the market, the S&P itself is a tale of two stories, right? You've got this very top-heavy benchmark where there's a few really expensive tech companies that have been leading the market. And then you've got the rest of the S&P 500 where the average stock is trading at, I think, close to the deepest discount we've seen in the history of our data relative to the index. So I feel like the index itself is kind of a problematic, animal. Furthermore, when you think about what the index is made up of, why do we compare today's S&P to the S&P 500 of 1980, right? Today's market, 50% of it is asset-light growth companies, tech, healthcare, higher margin industries, whereas back in the 80s, 70% of it was manufacturing. So I think the exercise of comparing today's multiple to historical averages is fraught with, problems. And then on top of that, I am actually very excited by what we're seeing from corporate America. We've seen margins remain relatively stable over the last few years, despite the fact that inflation went from negative to 9% to 3%. I mean, you would have thought we'd see some kind of hiccup in margins, but corporates did what they usually do, which is when they realize that things are getting more expensive, they focus on efficiency. So that's why I'm bullish. I think the long-term bull case for the S&P 500 and for the US corporate sector, healthy balance sheets, and they're focusing on efficiency.
So you are optimistic, but you're not like runaway optimistic. Certainly, you're sort of in among the, I guess, the median or the average.
Is that right?
Estimates.
Yeah.
Roughly, I think 6,500 is right. But yeah, I know you looked at history. We've had a big 2 years for the S&P 500.
Indeed, we have.
And so on the third year after that kind of performance, you looked at history and saw we don't tend to see another huge year.
Yeah, and I don't know how much stock I would put into that because, it's these historical analyses and technical reads are, again, it's harder to say, but I think that, typically 2 really strong years are not followed by another blockbuster year. So, 10% would be great. It's a little bit above average. And I think what's going to be more interesting, where I have really high conviction, is in terms of the leadership for the S&P. And I think it's going to be a much broader participation of stocks, and we've seen that this year in the second half up until recently. I think we're going to see large cap value stocks really crush it. That is my favorite size and style.
Why large cap values?
I know. This is what people look at me like I have 3 heads when I say large cap value. Well, large cap value is under the radar, right? Nobody talks about it. It's neglected. It's not a crowded area across active managers. But think about what's in large cap value. It's, big regulated companies that are going to get a break under a regulatory light administration. That's one thing we know about the red sweep and a Trump 2.0 cycle. You've got energy, you've got industrials, you've got materials, you've got real estate, you've got big old economy clunky companies, right? What have they done over the last 15 years? They have been denied capital, right? Who's gotten all the capital? It's tech, renewables, healthcare, like all these sexy growth stocks. Big value companies have been forced to rationalize capacity, clean up their balance sheets. They've paid down debt, termed out debt. They learned all their hard knocks in 2008, where they realized that leverage is evil. You don't want to be a levered company. And they've schooled themselves and become much more disciplined. Energy companies used to pay their C-suite on production targets. Today, they pay their C-suite on cash return and decarbonization. Totally different setup. So I like large cap value because I think these are companies that have been trained to survive in a higher real rate and a higher interest rate environment.
Right, but all of that said, what changes next year for them? Right?
So
is it regulation? Is it fiscal, or what changes for them?
I think it's all of the above, but I think that there's another really important catalyst that unlocks this value, which is there's a new buyer, there's a new value investor in the market. And we've been writing about this. We've seen that private capital, so private equity, private credit, these are asset classes that have burgeoned over the last, decade. And they're looking for long-term value. And what we're seeing is more privatizations, more take-privates of public companies. So it's kind of interesting because private equity and private credit are seeing these bombed out, value stocks that are economically sensitive. They're marked to the current interest rate and rates environment. And that's where the value is today. And, kind of thinking about this, we're at a point where old school CapEx is actually picking up. Companies are moving back to the US. They're building out grid, power, infrastructure. We haven't seen a refurbishment cycle in the US in a very long time. So that's where I think that old economy companies actually catch, some positive momentum.
What's really interesting, the name that pops into my head as you're talking about this is Warren Buffett. Because here is somebody who is the classic value investor, but he's been having a really hard time finding stuff to buy within value.
Yes.
So if the value investor's having trouble, what does that say about these other investors that you're talking about?
Well, I think that Warren Buffett, I could verify this, but I think he's probably already long a lot of the companies that are in that large cap value benchmark. On top of that, I think that, when you think about institutional money managers, we've lost a lot of value investors over the last few years. We haven't really seen value work that well because there's been no price discovery, right? We've had this momentum market, zero interest rates. There are periods where value doesn't work as an investment strategy, and those are periods where cash is worthless, right? Why would you want free cash flow yield if rates are zero? And that's basically where we've been for a lot of the last decade. So I think that challenge has worked against a lot of value investors. But today, where we're actually seeing the potential for real re-rating is, kind of companies that are, again, healthier, they've consolidated capacity, paid down debt. Did you know that the S&P healthcare sector, which is an asset-like growthier area of the economy and has done really well and gotten a lot of capital, healthcare now has the same leverage ratio as S&P industrials. This to me is surprising. I think of industrial companies as levered old economy businesses and healthcare as, kind of freewheeling, clean balance sheets. Same leverage ratio. The world has changed quite a bit since 2008. And I think that's what we as investors can take advantage of today.
Let me ask you, you would be hard pressed, Savita, probably. You spoke to a lot of strategists earlier this year in January, and you said, I think the S&P 500 is going to surge about 30% in 2024. What, as a strategist looking back, what surprised you?
Yeah, so I think the big surprise to me was the kind of still narrow leadership of the market. So I thought we would see a broader market earlier in the year. And what happened was you saw, kind of a continued bias towards mega cap growth stocks. Those were really the strongest components of the market for most of this year. So I think that was a surprise. Another surprise was just how well earnings materialized for those mega cap tech companies. But I think we're at a different point today. So here's my take. If you look at all these tech companies, they have told us the risk around AI is underinvesting. These CEOs have told us they plan to spend a lot of their profits on CapEx to remain competitive in this arms race to have the best tools, right? So all of a sudden, these big companies are going to be forced to cut into their profitability, and that's a newer theme. Over the last 12 to 24 months, we've mostly seen big tech companies get the money from, financial services companies and everybody else spending on tech. Now they're actually ponying up and investing in these businesses, and they kind of have to, right? In order to remain competitive, they can't underinvest. They have to really dominate the industry. So I think that's another big change that could cause mega cap tech to maybe take a back seat to some of the other areas of the market that are actually getting better trends.
We've been talking with a lot of strategists about the Trump trade and what that's going to look like next year.
Yeah.
What do you think the market is maybe getting wrong about the Trump trade right now?
I think the market is reading the Trump trade as just really excellent for M&A, and M&A is going to be the big theme over the next few years just because now companies can engage in M&A where they were blocked in prior years. I think this is wrong. I think companies are going to buy other companies if there's accretion, if there's value. And being able to buy a company, that's a necessary condition for engaging in M&A, but actually unlocking value and finding accretive value, that's really what companies want to do. And when you look at small caps versus large caps, what I think is interesting is that the cost of capital for small caps, the risk premium, is that much higher, right? Small companies aren't necessarily growing that well. They're still in a profits recession. The return on capital for small healthcare companies It's not great right now. Whereas large healthcare companies are actually growing better, and they shouldn't deploy their capital in buying the smaller companies. So I think that might disappoint. I think the idea that the Trump trade is just purely inflationary, that's also, I think, incorrect or maybe oversimplifying the issue. Because when you think about what's actually happening, yes, we get tariffs, which are potentially inflationary, but we also could get a big corporate tax cut. And what does that do? That could be actually disinflationary. So, little known fact, back in 2018, when we saw the first round of Trump corporate tax cuts, those benefits were almost immediately passed on to consumers through lower prices. So when a whole industry gets a break and they get, this benefit of a lower tax rate, it typically gets competed away, and it's almost, it's surprisingly disinflationary at the end of the day. So I think those are some of the surprises that we're seeing. I also don't think it's going to be as negative, from a headline perspective as what we're seeing right now. I think we're hearing a lot of saber rattling and a lot of really high numbers around tariffs, and every day they keep getting higher, and it's nerve-wracking. But again, I think where we are is an environment where these are the starting salvos, and the actual lay of the land will look relatively tempered over the next few years. That's my take, and I think that it's just game theory. From talking to corporate clients as well as institutional clients, corporates, even European corporate clients, are actually quite excited about the prospect of Trump 2.0. So I think that there's a different lens that you can paint this with.
Savita, great to catch up.
Yeah,
with you.
great
Thanks
to
so
be
much
here.
for coming in. Really appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, Bitcoin prices reaching new highs today, but will the run last through 2025? And how soon could a strategic reserve for digital currencies be put into place, if at all? We've got a strategist joining us later in the hour to give a few crypto predictions for the new year. And stop me if you've heard this one before, but Dan Ives is bullish on Tesla. We're going to be joined by Dan Ives himself on the other side. Shares the EV maker are rising higher once again today. He's got a new price target. And at 3:30, it's the latest edition of our series Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come. Wedbush out with a new note on Tesla, raising its price target and tying a street high of $515. Joining us now, the analyst behind that note, Dan Ives, Managing Director and Global Head of Technology Research at Wedbush Securities. Very festive shot there for our friend Dan. Dan, it's good to see you here. We know that you've been a long-time bull on Tesla, and you just keep getting sort of incrementally more bullish. What's the catalyst for this latest tick up in your price target?
Yeah, Julie, I mean, if you look at Trump in the White House, it's a total game changer for Musk and Tesla. The autonomous future is now ahead. And I believe autonomous is worth $1 trillion alone. And I think how the bears have missed this, the bears don't see AI in their spreadsheets. This is a name that's going to continue to move higher. I believe autonomous, robotics, disruptive tech, we could be looking at a $2 trillion market cap or higher as we go into 2025.
Now, another thing, though, sticking with all things Trump, Dan, Trump is a big believer, as we know, in tariffs as well. I mean, what happens? He hits, he does hit China with new tariffs. It's not crazy to think that Beijing then responds, reacts, retaliates. What could that mean for Tesla?
Look, I think the bromance between Musk and Trump, I mean, Musk is going to be heavily involved in the tariffs discussion. I believe there's going to be a carve out for Tesla, a carve out for Apple, and a carve out for NVIDIA and some more of the chips. And our view is Tesla ultimately wins because of their presence in China with what we see with the Gigafactory. And I think when you look across the board, Musk made a bet for the ages on Trump, and that continues to pay dividends. And that's why the stock obviously being meteoric, you're starting to see some bears, get on to the bull train. I just think it's a get out the popcorn moment. This continues to move higher.
Dan, what are the risks, though, with Musk's closeness with Trump? I mean, we have seen in the past that there have been folks who have been close to Trump in the first term, for example, who have been attention seekers, like an Elon Musk, and it hasn't necessarily turned out well for them in the longer term. Are you worried about that at all?
Look, I think this is going to be different. In other words, in some ways, they both need each other. I mean, Trump needs Musk, Musk needs Trump. I think this alliance actually gets stronger. From the AI innovation, the China tariff discussions. I mean, this is going to be for Karate Kid fans a sweep the leg moment when it comes to some of the stuff in the Beltway from NHTSA and obviously FTC and others. It's a bullish environment for big tech, right? And I think when you look at this AI party, it continues to be 10 p.m. It was 9 p.m. It's 10 p.m. It goes to 4 a.m. And now Musk is on the dance floor along with Jensen, Parr from Palantir, Nadella, and others.
Dan, what about Tesla's core EV business, more near term, over the next 12 months? The trajectory of that business looks like what to you, Dan?
Look, I think, Josh, we're going to see deliveries 15, 20% into next year. So deliveries are going to continue to increase from a delivery perspective. I think China starts to rebound. We're starting to see that this quarter. And then a lot of their price cuts have already happened in the rearview mirror. And that's why I'm not saying that there could be some things that still happen. Okay, we're going to have some bumps in the road. But this now is much more of a champagne moment for Musk and Tesla shareholders. And that's why a lot of the bears, they're going into hibernation mode, with their spreadsheets.
On the car business itself, Dan, there was a report today from Nikkei that Honda and Nissan were in talks to potentially have some kind of a merger, in part to provide a more formidable competitor in electric vehicles. How do you think about that competitive landscape?
Look, Julie, I think, especially with EV tax credits getting cut once Trump comes in, we're going to see consolidation from an EV perspective. You're also going to see a lot of the big three start to go more hybrid and maybe tone down that strategy. We're going to see international consolidation from Europe, I think, to parts of Asia. And this is going to play out. And ultimately, at the top of that mountain is Tesla. It continues to be Tesla's world, and everyone else is paying rent when it comes to the EV market.
Dan, always great to see you and to have you on the show. Happy holidays, my friend.
You too.
All right, now time for some of today's trending tickers sponsored by Tasty Trade, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, we're going to take a look here at Pfizer as the pharmaceutical company delivers upbeat full-year outlook for 2025. Looks like sales and earnings in 2025 basically in line with estimates. It looks like, Julie, revenue for next year, they're looking for between 61 and 64 billion. Profit outlook, they're calling between 280 to 3 a share. Stock rising in today's trade. Of course, it's because, as we know, a well-known activist investor has been circling. Starboard Value CEO Jeff Smith has been talking tough, but stock higher in today's trade.
Yeah, I mean, it's not as though the outlook is so fantastic, right? The midpoint of the outlook is pretty much, a little bit better than analysts had been anticipating, but that is a relief for Pfizer shareholders who have been waiting for the stock to recover. The stock is down by about half since late 2021. As we know, it was a pandemic high flyer, of course, with its vaccine. And since then, it has really come down at the same time that the company's been making a lot of big acquisitions. So, this is a bit of a relief rally, it seems to be, that we are seeing in the shares today.
Yeah, we just know Pfizer CEO Albert Bourla has been making the rounds, says he had dinner with Trump and RFK Jr., who, of course, is Trump's nominee to lead HHS.
Yes, well, let's talk more about the comments that Bourla made, actually, because it's moving other stocks. CEO Albert Bourla of Pfizer making remarks on President-elect Trump's strong views to, as he says, knock out prescription drug industry middlemen. Health insurance stocks are under pressure in today's session. So basically what we're seeing is this longer-term move out of health insurance stocks and pharmacy benefit managers in particular. They've been under fire on the Hill. They've been under fire from Trump. And now Bourla kind of re-emphasizing that, saying, quote, the president has very strong views on pharmacy benefit managers and that Trump wants transparency. So that's the latest blow.
Yeah, I went on to say it seems to me that he is very committed to make this happen. And Trump did offer those comments too, Julie, what you said we're going to knock out the middleman, he said. So just tough headlines continue. Of course, we know there's action on Capitol Hill as well. So tough news.
Yeah, continuing tough news. And let's also stick in the pharma and healthcare industry. Teva Pharmaceuticals and Sanofi both rising after the trial for their inflammatory bowel disease treatment meeting primary endpoints. This to treat ulcerative colitis or Crohn's disease, showing some promising results. And both the stocks, Teva in particular, really getting a lift off this.
Well, yeah, CEO of Teva called the results transformative. I see analysts at Jefferies site is saying, in their opinion, the results are encouraging, show impressive clinical benefits at the high dose. Bloomberg Intelligence analysts also weighing in, say the results from Teva met a relatively high bar, they said, set by rival drugs, establishes a potential commercial path for the asset.
And the year-to-date, Sanofi shares haven't done a whole heck of a lot, at least not the U.S.-listed shares. Teva shares have already doubled this year.
Wow.
Yeah.
What a chart. All right, Bitcoin just keeps going up. The cryptocurrency briefly hitting a new record high of just over 108,000 today. That's thanks to, of course, we know optimism over Bitcoin-friendly policies and Donald Trump's incoming administration and flows into Bitcoin spot ETFs. Joining us now to help us look ahead at what 2025 could look like for the crypto industry is Matt Hogan, Bitwise Asset Management CIO. Matt, always good to see you. So obviously, listen, Bitcoin has enjoyed this incredible run, Matt. As we look ahead now to 2025, 12 months from now, Matt, it's December 2025. We're talking here. Bitcoin is where, Matt? What do you forecast?
It's great to be here. We're going to have the same conversation that Bitcoin has had an incredible run. We expect Bitcoin to be up above $200,000 by this time next year. There are just three irrepressible sources of demand driving the market. You have ETFs that are vacuuming up Bitcoin. You have public companies like MicroStrategy vacuuming up Bitcoin. And now we're talking about governments vacuuming up Bitcoin. At the end of the day, it comes down to supply and demand. There's too much demand, not enough supply. And so I think the price goes higher in 2025.
I mean, Matt, rarely, though, do you see demand for an asset so sustained over this kind of a time period, right? Does it need new catalysts, or, is this effectively just a momentum trade with nothing really to stop it?
Well, I think the real story is people just wake up to Bitcoin at different paces. We saw retail investors get there first. We've seen companies and financial advisors get there. We're starting to see institutions get there. And once they realize that Bitcoin's not going away, that it belongs in a portfolio, they have to get off zero, get to 1%. BlackRock now says 2%. So it's just this cascading series of educational breakthroughs that brings new people into the market. Look, Bitcoin is now a global macro asset. It's a few $trillion. Pretty much every investor should have some, and we still have a large number of investors to go. That's why I think this is maybe a momentum trade, maybe it's a one-off introduction, but we're still early in that journey. We have many quarters to go.
In terms of potential catalysts, Matt, I got to ask you about Trump and his support for this idea of a Bitcoin strategic reserve, Matt. What do you make of that? What do you think the odds are that actually happens? If it did happen, what would it mean for the price?
Yeah, I'll answer that last one first. If we do get a Bitcoin strategic reserve where the government is buying Bitcoin, and there's a bill from Senator Lummis that had the government buy 1 million Bitcoin, $200,000 Bitcoin is going to be looking quaint. You're going to be looking at $300,000, $400,000, $500,000 Bitcoin. It's just too big a story because governments all around the world would have to do it. When this initial idea was floated, I was somewhat skeptical of it, but over the months, it hasn't gone away. In fact, we continue to see leaders in the Trump administration suggest that they're open to it. I still think, maybe it's less than a 50% chance, but it's not zero. And again, if it happens, or if we start to see it happening in other countries, you're going to see, a rip up in Bitcoin that will make 2024 look pretty docile in comparison.
And one of the other predictions that you have for the coming year is that Coinbase is going to be a big beneficiary here. So big a beneficiary, then it's going to surpass Schwab in terms of a brokerage size. Talk us through how you get from here to there.
Yeah, right now it's about half the size of Charles Schwab, and we think it could reach that and more. Coinbase is this really unique opportunity because there was so much regulatory suppression over the past few years. Coinbase hasn't had major competitors bubbling up to challenge it. It's sort of had a degree of regulatory capture, if you can believe it. And as a result, it's been able to sustain its high margins in brokerages and then layer on things like stable coins, like its layer 2 network base. It's executing extremely well. It has a limited competitive environment. And it's in an industry that's growing 100% year over year. When you add those three things together, you'll see this vault up the spectrum. It'll also help if it gets into the S&P 500 and you see institutions buying it broadly. But I think it's a really unique situation driven by the fact that there was so much regulatory uncertainty. It cleared the competitive path, and now it's going to reap those rewards and build really, maybe an unassailable position leading this industry in the U.S.
And Matt, another theme we're talking about heading into next year is whether that IPO window, Matt, swings open. I'm curious whether you think you're going to see more crypto names next year, Tesla's public markets, and if so, Matt, any names on your radar?
Yeah, absolutely. Again, this is a story of regulatory suppression. You can imagine the negative regulatory environment sort of pushing the lid down on crypto for the past few years. And now that's being released, the lid's going to come off, where you think we'll see multiple firms come to market. Firms like Kraken, which is a Coinbase competitor, firms like Anchorage, which is a leading custodian, Chainalysis, which is a digital data firm. There may be a dozen high-quality companies that are big enough to go public. They're due to go public, and I think they will go public, and that will just further normalize this industry. Every American will own crypto in their brokerage account through these companies. We'll see Wall Street coverage. It's going to be a very positive theme, and I think you're maybe already starting to see that. You're starting to see companies uplist into markets. I think the IPO window explodes in 2025.
Gosh, Matt, all of your predictions are positive ones. I got to ask you, what could go wrong? Because the way you're describing it, is perfect, right? For crypto investors across the board. Are there any risks here?
This has been what's been keeping me up at night, re-underwriting my bullish thesis. Of course there are risks. The biggest risk is that politicians don't deliver on their promises. We don't get regulatory clarity as fast as we think. We don't get a high-quality stablecoin bill, or the industry, the traditional finance industry, interferes with those bills, so they're not really pro-crypto and sort of pro-economic freedom. Regulation and politics are supposed to be a big driver of crypto in 2025. And if they deliver on their promises, I think it's an extraordinary bull market. But the proof will be in the pudding. We haven't seen these bills. We haven't seen the strategic reserve. So that's the biggest risk is politicians not delivering.
Matt, always great to see you and to have you on the show. Happy holidays.
Thank you. Happy holidays to y'all too.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. I'm here with ER Shares COO Eva Ados, and let's get right to your buy here, which is also a top holding in one of your ETFs, and that is AppLovin. Now, AppLovin is notable because the shares are up more than 700% this year, which is pretty incredible already. Let's get to why you think it should keep going. You're looking at the gross margin picture for AppLovin. Tell us what you see there.
So the gross margin has been increasing. They've been cutting SG&A costs significantly. So as a result, its EBITDA margin is the most important statistic to look at. This company has a 46% EBITDA margin compared to 7.5% for the rest of the category. That's why it's our first public, number one biggest weight in terms of public equities, but our number one private equity holding is SpaceX. That's 12% of our portfolio is in SpaceX, and the rest of it is in our ER30 TR index. AppLovin is the #1 holding of our ER30 TR index. And we got into it in early 2023 when we realized that this is an AI play that's very different from all others.
And so let's talk about that a little bit. Well, let's get to the revenue growth also before we get to the sort of how it fits into AI, because you talked about gross margins, and indeed, 46% EBITDA margin is high, as you talked about. Revenue growth is also higher.
Very high. So the revenue growth that it has, it's by far the biggest in this category. And the result of it is that app developers are now able to use AI through AppLovin to better market their apps, to optimize their ad campaigns, and to specifically target the right user. That's the only company that offers that. So what's important with this, it's unlike any other AI play. This is an AI play that most people haven't realized that
is an AI
it's a
play,
hidden AI play. People are focused on NVIDIA and other important AI companies, but this is a hidden gem that our Entrepreneur 30 TR index was able to show us that this is a specific AI play that most people won't even realize.
Well, somebody realized because the stock is up 700% over the past year.
But we were able to figure out very early on. So this entrepreneur model was able to show us that this company has major potential even after the 710% appreciation.
Right.
This is a company that its price to earnings ratio is very highly priced, very attractively priced.
Yeah, interesting. Okay, so let's talk about what could happen that could go wrong. And you think basically macro factors. If we saw a market downturn, that's one of the risks here.
Correct. And I think we're all focused on tomorrow's announcement. We'll see the Fed. We're expecting probably a 25 basis point rate cut. But the most important is what the Fed Chair Powell will say. So it is high. Again, it went up 700% year to date, but the price to earnings ratio is still attractive. But that being said, it's better to be maybe in private companies. That's why we put 12% of our portfolio right now in SpaceX to allow people to get access to private companies that they have never really been able to access.
Gotcha.
So in the past, it was really hard for retail investors to get access to private companies such as SpaceX, and we're trying to make this available to the company.
Alongside something like AppLovin. All right, let's get to a stock that you're avoiding right now, and that is Cigna. Now, these shares, particularly as of late, have really seen a downturn, and we know what's going on here. We were just talking about it earlier in the show, where President-elect Trump has talked about pharmacy benefit managers. He's not the only one, but he's talked in recent days critically.
Correct. And these are companies, Cigna and CVS, as well as United Health, are the three biggest PBMs, pharmacy benefit managers. And they've been targeted, it's a bipartisan really targeting. From both sides, they've been targeted. And what's important about this company, as well as United Health, is that their margins were dropping far before what happened recently, the tragic event. So we saw decline in every single margin, gross margin, EBITDA margin, everything was dropping. And in addition to the growth that's coming down, their price to earnings ratio is still higher than the rest of the categories. So in this case, it's 26 compared to 15 for the rest of the category. So it is priced high. In addition to the fact that everything is dropping, again, Trump is targeting, bipartisan targeting, there's not a lot of room to be optimistic for the industry in general, but Cigna, CVS, and United Health definitely are companies to avoid.
Well, and it's interesting because with none of these, it's not their main business, right? The health insurance business is larger than the PBM business, I believe, at all three of these companies, and yet it's really been weighing on them.
And it's interesting, as you said, because it's hidden through subsidiaries. So it's not that the companies itself are PBMs, but they own other companies inside them that's PBMs. So sometimes it's hard for analysts to notice the effect that this, targeting will have to the company overall.
And let's talk about what maybe could go right for Cigna, and that's maybe just sort of a policy change here or some kind of political change with regards to these companies.
So in this case, these companies are facing, again, regulations. PBMs are being... people think that PBMs are the reason why drug prices have increased in the recent years. So I think everyone is targeting them. And so
So you think this is unlikely, in other words, that he would change his mind?
Correct. It's unlikely that he's, because everyone now is against them. There's a lot of focus. These are companies that are on the spotlight, and I don't think this will change. There are so many good opportunities right now to look at in private equity. Like we said, the XOVR fund offers this, as well as public equities. There are many good opportunities that if, we'll see tomorrow what happens, but if we do have a Christmas rally that many people are expecting, I think investors will be very happy to investigate other options and get out of these names that have like bad reputation.
Yeah, exactly. So obviously you don't own this one. Thank you so much for being here.
Thank you for having me.
Appreciate it. And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Stick around, much more market domination still to come.
Where Applebee's and Chili's taking to their value meal deal rivalry right to social media. Applebee's ignited the exchange in a post on X, implying its value deal is better than its competitor Chili's. It did not take long for Chili's, though, to reply to that post, highlighting its slew of offerings with its 3 for $10.99 deal. Applebee's president Tony Moralejo sharing with Yahoo Finance his thoughts on the competitive spirit.
When the original post came in, I was sitting right next to my CMO, and he showed it to me. I said, let's go right now. So yeah, it gets a little bit intense. So the gloves come off pretty quick.
All right, well, for more on the value deal rivalries, we now have Brinker International CEO Kevin Hochman, along with our very own Yahoo Finance, Brian Sozzi. Kevin, it is great to see you. So we did have Applebee's Tony Moralejo on the show yesterday, Kevin, and Tony came in hot. He broke some news. He said, you know what, here's what we're bringing our customers: endless fries, Kevin. And I said to him, I said, hold on a second, Tony, is this just you responding to Chili's unlimited salsa and chips? And he just shrugged that right off, Kevin. Take a listen to what he told us.
I mean, salsa and chips, it's filler, right? It's like some brands give you bread. Like when I was a little boy, my mom used to say, don't fill up on the bread, right? Because you want to save your appetite for that center of the plate sandwich.
So, Kevin, I have to ask you, what do you make of that? I mean, he just comes right at you. He says, chips and salsa, unlimited. Who cares? It's just filler. What do you say?
Well, we've been really winning in the industry. We posted a plus 14 comp last quarter. I appreciate what's going on here, but here's the reality of it. We're leading the industry on value. I think we've got folks that are trying to copy us. I think that's really good for the consumer because they're going to get better value, and it's very flattering to us. And so, anything that can bring, news to our unbeatable value of $10.99 in the marketplace is a good thing. I always tell our marketers, our consumers and our customers, they're not waiting for an ad from Chili's. So anything that gets us in the news that we have unbeatable value is a good thing for our business.
Hey, Kevin, good to see you here. It's Brian. I asked Tony this yesterday, and he kind of, he sidestepped. Tony seemed like a nice guy, so it was the first time talking to him. Nonetheless, I said, why is Chili's crushing you guys? Why are they putting up a 14% same-store sales increase? And Applebee's same-store sales were down 6% in the most recent quarter. Your stock price has gone up through the roof. Their stock price has gone straight down. What are you doing that they're not doing? Why are you grabbing market share from them in a competitive environment, you think?
Yeah, hi, Brian. We've been committed to the fundamentals for about 2.5 years now. So I always talk about it. We've been in the gym. We're pumping iron on things like better food, better service. We spent hundreds of millions of dollars both on labor inside the buildings as well as improving the facilities. And now we're seeing the fruits of that labor. So, we've had a couple of quarters now of double-digit comp growth. There's an exceptional strength in the business right now. And really what's happening is customers are seeing the ads on TV or they're seeing the ads in TikTok. They're excited about coming to Chili's. They're having an amazing experience, and then they're coming back. And that's really why we have momentum in the business. We've been in the gym for the last 2.5 years. We're built now to win, and that's what's happening in the marketplace.
Hey, as someone always in that gym, Kevin, I can appreciate y'all are pumping iron. One of the cool things of working Yahoo Finance, we have a very large, huge audience. And after that Applebee's segment, we had a user post a tweet or an X post, whatever you want to call it to me, after that segment, calling out, this is what they said: it's rather shocking that Applebee's president thinks endless fries and soft drink refills are going to elevate their position to competitive with, much less exceed, out of Chili's. Not the flex he thinks it is by far. Are you just, take us through some of the things you're doing operationally in the restaurants, because I do think there's a component of marketing to the sales you've put up, Kevin. You're a master marketer. You and I have talked about this for many years, but operationally, what's different under your leadership? Yeah,
I'm so excited. So our COO, Doug Cummings, and many of his vice presidents of operations, the regional leaders, they host me in market very frequently. I'm like a geek. I take out my laptop and I ask the area managers, usually there's about 15 or 20 of them in the room, and I'll say, hey, if you were the CEO, what's one thing that you would change to make the operation easier or better serve our guests? We have a laundry list of ideas, and every period we're making changes to the restaurants that are helping our teams work. So I'll give you an example that happened the other day, right? We've got so much traffic coming in for our triple dipper that's gone viral on TikTok. And it's difficult for the team members to keep up with all of the Southwest egg rolls and mozzarella sticks that they got to make. And they're like, hey, could you change the technology so we have something called an all-day counter, which just tells us how many chicken crispers to make, how many mozzarella sticks to make, so I don't have to go through 17 tickets that come in on a busy Friday night to understand how many things I have to prepare. That would make my job a ton easier. Our team has literally started coding that last couple of weeks. We're going to have that in test in a restaurant tomorrow. And by 1st of January, we're going to have that new counter, in every restaurant in the system. So that's the kind of things that we're doing when we say we're in the gym working out. We're taking the ideas from the teams, we're putting them into the restaurants, and then we're seeing, record guest metrics like food grade scores and intent to return.
Kevin, we did get retail sales numbers today, broadly solid. There were some weak patches, though, some soft spots, Kevin, and one was food services sales. You have a great look, a great read into the consumer. How does the American consumer look to you right now?
Yeah, honestly, we really haven't felt the kind of the pinch that I think the industry has been feeling. And I talked about this a couple of years ago. I got asked, what's going to happen if the there'll be an economic slowdown? And I said, I don't think it's going to change what we're doing. In our turnaround, it was all about getting back to the fundamentals of casual dining, which is great food with great service in a fun and friendly atmosphere. And we've been doing that the last couple of years, because if you're going to pull back on trips because of the economy, right, you're going to go to the places that you trust. And Chili's, fortunately for us, is now a part of that consideration set for, concepts that people know that they can go and have a great meal at a great value. And so, I will tell you, I think that's been the key to our turnaround is doing the fundamentals so well that we become, a restaurant of choice for people.
Clearly, Kevin, value is a focus right now in the restaurant industry. Two-part question, if you can indulge me, no pun intended. First up, McDonald's, you were spending many years at Yum Brands with KFC, many other brands. They're about to launch a new value platform in January. What type of impact do you think that will have on the wider fast food industry? And then number two, is your industry one that can give away things for like endless this, endless that? You heard Applebee's talking about they want to give away endless fries. Well, we just had a chain like Red Lobster basically almost go out of business because they're giving away endless shrimp. Can the industry afford to do that?
Yeah, so I think anytime like a leader like McDonald's or Chili's, in casual dining does things that are going to help the consumer, that's going to help everybody, because the other folks that we're competing against, they're looking to see what we're doing and saying how can I get a piece of that? And so anytime you have an industry leader like McDonald's or Chili's doing those types of things, it's going to really benefit the consumer. So that's the first thing I tell you. I think it's going to be a good impact on the industry and help drive traffic into restaurants in general, which I think is good for everybody, right? What was your second question, Brian? I'm sorry, I forgot.
Well, can the industry afford to give away endless stuff? So you had Applebee's talking about endless fries. You had Red Lobster basically almost go out of business for endless shrimp. I mean, is that where we're headed here? Can you guys afford to do that?
Well, it's not where we're headed. We're focused on delivering on all guest needs. So, for example, we know that there's some guests that only have, $10.99 to spend on a meal, and we're going to focus, making sure that guest gets an amazing value. That almost half-pound burger, fries, unlimited chips and salsa, and bottomless drink, and they can get it for that price point. But you know what? Not everybody that comes to Chili's, just wants that meal. So, for example, in margaritas, your favorite, Brian, our $6, margarita of the month. If you want something that's really good with Luna Azul, and blackberry syrup, you can get that for $6. But if you want something a little bit more smooth, like our new Don Julio with orange, that's going to retail for over $10. And the reality is, as long as we meet both of those guest needs, the P&L is going to be great. And that's what we've seen. We've seen not just top line growth, but our margins expand, and we're going to continue to do that as long as we meet all guest needs, not just one or the other.
I don't want to speak for you, Josh, but I think we're like espresso martini guys now. We're like elder statesmen now. We're espresso martinis. We've up-leveled here.
The margarita and fajitas sound amazing.
Yeah, they do.
I'm all
They're
in.
sizzling,
I'm all in. Kevin, thank you so much.
Brian, I got to
Go
say
ahead,
one
Kevin,
thing before we go. We have an espresso martini that
of course.
One of our leaders, Jesse Johnson, created, and it comes with tequila. You got to try it. It's so much better than a vodka one.
I'm in. I know Sazi's in. Kevin, thank you so much for your time today. Appreciate it.
Hey, thanks, guys. Great to see you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here. The Dow falling again today, down 267 points, about 0.6%. This is the 9th straight session that we are seeing that index lower here, and it really has been a big bifurcation with what we've seen from the Nasdaq, but not today. The Nasdaq's down 2 today. It's off by 1/3 of 1%, so only down half as much as the Dow, but even so, bringing to a bit of a halt its recent surge. The S&P 500 down about 0.4%, and we continue to see the equal weight underperform. So on a relative basis, we continue to see large cap tech do better, or at least the largest of the large cap companies do better. So we see this equal weight underperformance. And Jared, maybe you can tell me this. Are we still seeing decliners outpacing advancers, something that we've been seeing very frequently here, I think every single trading day thus far in December?
Yes, I believe that is the case again today. And while I have the S&P 500 equal weight index behind me that you just left up there, I would add that this is, I believe, the 11th of the last 12 days that it has been down. And so, you add to that the Dow streak of being down 9 days. And there are some other streaks that are really interesting. I'm going to dig into this with Josh in about 30 minutes. Materials is down 12 days. Value itself, the ETF, VLUE, is down 12 days. So something's going on here. And we got a few clues from the B of A Global Fund Manager Survey. All ties together here. That's in 30 minutes. But first, let's go to the sector action. Consumer discretionary up 1/3% today. That was a sole bright spot, and I believe we can thank Tesla for that. Industrials was down the biggest amount by about 0.9%. Communication services, energy, financials, all down more than 0.7%. And here's the Nasdaq, and indeed Tesla up. That should be another record high. And let's just graph chart the year to date, 93%. So Tesla flying high, but not necessarily everything else. Broadcom taking a back seat after just surging incredibly for the last few days. And let's just pull up a 3-day chart of Broadcom. You can see up 33% over the last 10 days, 43%. So that stock has just been on a tear. But for the most part, the mega caps, besides Tesla, not doing a whole lot. Apple up 1%. Amazon down less than 1%, so is Meta. Nvidia down 1.2%. When we look at the leaders, we get another clue as to what's going on here. Regional banks down 2%. SOX, that's a chip ETF, that's down 1.4%. Looks like Korean stocks, momentum, home builders, those are flagging a bit. So there's some suggestions that interest rates might be at play here. But the biggest gainer is cannabis, and the other biggest gainer is China. Both of those kind of detached from U.S. fundamentals, so not going to make too much of that. All in all, an interesting day. We're going to try and sort it out in a bit, Josh, aren't we?
That's right, Jared. See you soon. Tough day on Wall Street. The Dow extending its losing streak to 9 straight sessions. That is the first time that's happened since 1978. And joining us now is Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer. Jeremy, let me actually start you on that stat. The Dow extending its losing streak to 9 straight sessions. First time that's happened since 1978. Which actually surprises me, that stat. That's a long time ago, but what explains that? What do you make of that? What should investors make of that?
It's been such a strong year, so you're taking a little bit of a breather. Actually, a few weeks ago on our show, we were saying everybody's positioned for one way. Everybody was saying this is good seasonal time. We've got the election. We've already had a good year. We're going to have a good environment, and really everybody's been all in on stocks in so many ways. So it actually doesn't surprise us. They're pulling back a little bit. We are still optimistic for next year. We think stocks versus bonds, it still favors to be in the markets, but there was so much strong positioning for this rally and for this seasonal rally that it's not actually a surprise to see this pullback.
What do you make of the divergence, though, between the mega cap tech and the Dow in particular, and the S&P equal weight for that matter, right? That's been an interesting move over the last, I mean, not today necessarily, but over the last several weeks.
And a lot of it's the same trade. You know, when you go from equal weighted to cap weighted, it's really the big tech, the big magnificent seven stocks, Tesla, Nvidia, all these big stocks driving the market higher. So it's really the tech leadership versus everything else, value versus growth, all those kind of things. We have been all positioning or talking about when is this rotation going to happen, and we still believe that there's good catalysts for that. For next year, as you think about rebalancing.
What would those catalysts be, Jeremy?
So lower tax rates, if they do materialize, there's at least not higher tax rates. There was fears on small caps that tax rates would go up. The small companies pay the highest tax rates. They don't have, the tech companies go to Ireland or Puerto Rico and pay much lower tax rates. So the small companies could have faced the biggest tax hike if there were tax rates going higher. Rates coming down, we think rates are still gradually coming down next year. They're the ones paying the higher rates. And just less regulation. If that comes to materialize, the small companies tend to be disproportionately benefiting from that versus, say, the mega tech companies. So I think there's a few potential administration catalysts that could be positive for small, for value stocks, for more local economy US stocks.
What about the lack of catalyst, perhaps, for more Federal Reserve rate cuts? Or do you think there are more cuts coming after tomorrow?
Well, tomorrow that could be one of those things that the market confronts is, will the dot plot say more people only expect 2 cuts? And that could be a jarring thing for the market tomorrow is, hey, there's so many more people only thinking 2 cuts next year. Our view, baseline view, is that inflation is coming down. And actually we have some real-time metrics of inflation that says it's basically a singular issue. Yes, there's ups and downs, but shelter is still like the main driver. When we put in real-time shelter, we get less than 2% core inflation, 1.8% instead of 3.3 officially. So there's room for the numbers to officially keep coming down next year and for them to cut. But there is this fear that, well, what's going to be the new policies? Will inflation be stickier? Will tariffs make higher inflation? All sorts of question marks for next year. But so they're going to likely pause. So they'll be a hawkish cut. So they'll cut, say, hey, we're going to pause in January, or insinuate they're going to pause in January. They'll be data dependent, and the dot plot should keep rising. Their terminal rate today, we think, needs to be like 3.5 to 4. Today it's only 2.9. So they're going to keep bumping up that long-term projected neutral rate, and that might be a little jarring tomorrow as well. But we still think inflation is generally coming down. They have room to cut even further to that.
What about this idea, and you'll hear this, some folks say, you mentioned the new policies in Washington. Some folks say there's so much uncertainty with those new policies, taxes, regulation, tariffs. Why not wait? Why not take a pause, a deep breath, see how things unfold a bit before making a move?
Yeah, there is a lot of uncertainty for next year, and I think that's partly what's happening right now. Is there's some of this rotation and the pause. You get past the Fed meeting, all these uncertainties. Markets don't like uncertainty, but we have some clarity. I mean, you don't know what the policies will be, but you have directionally where they're going. And so, I do think if there's a risk, it's the valuation risk. The tech stocks do have higher multiples. They need the earnings growth to deliver. The risk of high multiples is there's higher expectations. When you have a 12, 13 PE stock, which are small caps, value, quality small caps, you don't have as much expectations built in, less room to disappoint. If you're at 30, 35, 40 times earnings, more room to disappoint on earnings. Now, these tech companies keep powering higher, but at some point, it becomes harder to deliver.
So do you think small caps are the way to go going into next year then? I mean, we've heard a lot of rhetoric about small caps, and they haven't done so great. And we've also heard a lot of criticism that they are unprofitable, or that a lot of them are unprofitable.
One of our favorite funds, we have a fund called the Wisdom Tree Value Fund, WTV. It has a dividend buyback focus. So the net shareholder yield on this fund is close to 7%. It means they have almost a 2% dividend yield. They're buying back 5% of their shares outstanding. I heard you just talk about AppLovin on your last segment. We had that stock in that portfolio all of last year. It contributed a huge amount to the gains. It became expensive. We actually just sold AppLovin at our recent rebalance. But that strategy is meant to buy cheap stocks, 7% average shareholder yield, 13, 14 PEs. It skews away from the Magnificent Seven. It's sort of a flatter weighting scheme. We think that's one of the better places to be today.
That's also interesting because we had Savita Subramanian of Bank of America on at the top of the show. She loves value in 2025.
Well, this is a very unique way of doing it with the dividend buyback focus.
Jeremy, good to see you. Thanks for
Julie.
coming in. Appreciate it. Well, outgoing FTC Chair Lina Khan still looking to make changes in her final weeks on the job. The agency finalizing rules to ban surprise junk fees, as they call them, for live event tickets, hotels, and vacation rentals. Basically, the rule requires companies to disclose total prices up front instead of adding things like resort or convenience fees when you get the final bill. Now, that rule is going to take effect in April of next year. And on the day, we did see mixed moves for things like hotel stocks. Live Nation, by the way, did issue a statement on the news saying the company supports the push and has supported the push ever since the FTC started looking on it. But this does seem to be a response to some of the stuff that's happened in the live event industry and elsewhere over the past
It's a push
year.
generally for more transparency.
Yeah.
I'm seeing reports that officials estimate the rule could save consumers up to 53 million hours of wasted time per year, Julian, searching for the total price.
That sounds like a lot of hours.
That sounds like a lot. There's a quote here from FTC Chair Lina Khan saying people deserve to know up front what they're being asked to pay without worrying that they'll later be saddled with mysterious fees that they haven't budgeted for and can't avoid.
I mean, some of these companies have been trying to get ahead of a rule like this. Like, I don't know if you've booked an Airbnb lately, but they now give you the option of seeing either the per night price with the breakdown or the all-in price for your entire stay, and they break out the cleaning fees and all that kind of stuff, although they have done that. So, you know, it's reasonable to think that some of the companies anticipated this and have been doing it. Live Nation says that they've also been transparent about their pricing in
I've
that
seen
statement.
reports, too, that these sort of efforts actually ramped up in recent years. You knew it was going to come to this after fans struggled to purchase tickets for Taylor Swift's tour when it was announced in 2022.
She's the root of everything,
She's
Josh.
everywhere, Julie. She's everywhere.
All right, coming up, how might President-elect Donald Trump's actions affect the energy transition, and what effect might it have on investors as well? We will discuss more market domination overtime coming right up. As investors prepare for President-elect Trump to take office, we're looking at what a second Trump term could mean for the power and energy sectors. For more, we're bringing in Eli Horton, Senior Portfolio Manager at TCW. He manages the NETZ with a Z ETF, among others. And we haven't had the chance to talk. We talk all the time about the energy transition. We haven't had the chance to speak since the election. And so I wonder how, if at all, this changes the calculus for what we're looking at in terms of the energy transition and some of the companies in your portfolio.
Okay, I'd say, well, first of all, it's great to see you again, Julie. I'd say on the margin, the Republican administration should be favorable for the energy transformation. We've long taken the view that this is a decades-long journey, it requires a ton of capital, but to migrate from a fossil fuel-based system to renewables, you need to invest in the old economy, the brown companies. I think we're set up for that. Drill, baby, drill has obviously been a mantra. Think about the power system. We need more reliable power in this country. We can't do it all with wind and solar. I think nat gas is a very important alternative. This administration's in favor of that. And the last thing I'll say is we're very excited about the deregulation potential.
Are you concerned at all, though, about, because you do have the so-called brown companies in your portfolio, you have power companies in your portfolio, but you also have some of the renewables there, too. Do you worry about a disadvantage for some of the solar companies, the wind companies, the rest?
Look, that's our job. We are trying to select the best investments that we can find for our investors and put them in a concentrated portfolio. So we manage a portfolio of 20 to 25 stocks. So we're trying to consider all of these risks. At this time, we see far more interesting opportunities in brown than in the green companies. We only own one green business in the portfolio today, First Solar, which we think has a very credible path to accelerating earnings growth over the next 5 years. But for the most part, we're finding better opportunities in businesses, in natural gas, for example, like GE Vernova, or in power distribution. So brown companies is where we're focused.
We actually had the chance to talk to Scott Strazik, the CEO of GE Vernova, recently, and he talked about the transition as well. I want to play for you what he had to say.
So I wouldn't say sustainability has taken a back seat to electrification. Both matter. But in the near term, we're in an arms race to kind of compete with things like AI, and gas is an incredible scaled solution for this decade.
So effectively saying some of the same things that you're talking about, which is the need for consistency of power because of things like AI. What is that going to mean for a company like GE Vernova, for example?
Look, so Scott's done a really nice job with GE Vernova. They are a leader in manufacturing and servicing natural gas turbines. We are accelerating demand for electricity in this country at levels we haven't seen in decades. We're electrifying everything. We are bringing manufacturing back, and now we need to power AI. Just take AI. We could need to add as much as 70 gigawatts of power to the grid by the end of this decade. If you take what's in construction and permitted, that probably still leaves you with 50 gigawatts incremental. New York City consumes about 6 gigawatts per year. So we're talking, what is that, 8, 9, 10, the amount of New York City's added to the grid. You can't do that with wind and solar. It's intermittent, it takes too long to add it to the grid. And so businesses like GE Vernova that provide nat gas solutions 24/7, certainly a lot more efficient than coal for the environment. We think there's a really good path for them to adding value in the system.
When you look at some of the biggest holdings you guys have, it's also the big traditional power companies like a Constellation Energy, for example. Since they are regulated entities, they can't just raise their rates willy-nilly. Is that increase in demand going to be enough for them to really see a meaningful difference in their numbers?
So let me sort of frame one thing we like to look for, and that is businesses that sit in bottlenecks where demand far outstrips the amount of supply. And nuclear is the definition of a bottleneck right now. This country has about 95 active nuclear reactors. We've only added, I think, 3 since the year 2000. We have none on the large scale to be built, and small modular reactors won't come online until 2030 to 2035. So we're scarce or short nuclear power. Constellation and another company we own called Vistra are the largest producers of nuclear power in the country. And there is excessive demand for their power because it's 24/7, it doesn't emit carbon, and we've seen companies like Amazon, Microsoft enter into contracts with the companies to procure that power for their data centers. The biggest one was 3 Mile Island, where Microsoft is basically partnering with Constellation to open one of those reactors. I think that's a stunning headline. It speaks to how important this fuel source or power source is in the transformation.
It's a stunning headline. How material is that going to be for Constellation? Financially, what is that going to mean for them going forward?
It's significant.
We don't know the specific terms of that agreement, right?
You can deduct some of the terms. Let me put some numbers around it. So at the beginning of the year, the prevailing price for nuclear power was about $45 a megawatt hour. Amazon did a deal with Talon. That 45 stepped up to about 70 in that deal. And Microsoft is paying somewhere in the 130 to 140 per megawatt hour with the most recent arrangement. So 45 up to 130, that's a tripling or so just this year. And now you asked about the regulation or how regulated are Constellation and Vistra. So they have regulated utility businesses, but they also have a merchant power business, and that's where the growth is. So they generate more power.
And these deals are outside of the regulated
100%.
business.
They generate more power than they can sell to their customers, and they sell that power into the open market, and that's where they're capturing that price spread.
All right, good to see you, Eli.
You too,
Thanks
Julie.
for coming in,
Thanks.
appreciate it. Josh?
Spotify is on track to hit full-year profitability for the first time ever as the stock trades over $400 a share. That's a stark contrast, of course, from the below 80 a share in 2022. With more on Spotify's turnaround journey, we have Yahoo Finance's Alexandra Canal. Allie.
It's always nice when you could talk about the good things that are happening to a stock, especially for a company like Spotify. You just mentioned the share price has come back for Spotify. I also want to shout out the market cap. We're at about $100 billion today. That's up from just $15 billion 2 years ago. Now, of course, this comes after a significant overhaul at the company. It's included everything from mass layoffs and C-suite shakeups to a major strategic shift away from podcasts, which is an area that we know Spotify has aggressively pursued, spending over $1 billion between 2019 and 2021 just to break into that crowded podcast market. And if you remember, at the company's 2022 Investor Day, Spotify set these very lofty objectives that included long-term gross margin targets between 30% and 35%. At the time, the company had really been struggling to turn a profit. Gross margins were stuck at around 25%, and Wall Street watchers were not confident the company could get there. Flash forward to today, though, margins are at 31.1%. So how did Spotify do it? Well, it really all started in early 2023. At that time, the company reorganized and consolidated business units. It adjusted that very expensive podcast strategy to focus more on distribution, really tightened up that content spending, changed up its royalty structure to curb streaming fraud, and finally, the two biggies. They raised prices and they enacted mass layoffs. And this is what analysts have told me was incredibly unique, since you had these aggressive cost-cutting measures at a time when the company was also boosting top-line growth with those price increases. So it was that really dual effect that helped set up the company with an attractive profit profile in 2024. And then throughout the course of this past year, the changes didn't stop. They hired a new CFO. They made a greater push into audiobooks, and audiobooks are really important because they create bundling opportunities. So Spotify can not only raise prices, but also attract larger audiences. So ultimately, what it all boils down to is that Spotify was really able to show that value to investors. Engagement remains strong, churn still low despite those price increases, and then the value add of these new bundles, these new premium offerings that only strengthens its positioning heading into 2025.
Thanks, Allie. Appreciate it. Well, lawmakers say they have a deal to avert a government shutdown this Friday. What's in the deal? Well, no one knows that for sure yet. But here to help us understand what could be included, Yahoo Finance's Ben Werschel. Ben, so I guess they haven't revealed the details yet, but tell us what we know.
Right, exactly. If that intro is confusing for folks, I don't disagree with you, and sort of welcome to Congress, welcome to covering Congress. We do know some big parts of it though, for sure. We know that the government's set to have a shutdown on Friday if Congress doesn't act, and what this bill will do is extend that deadline until next year, March 14th specifically. So that's the top line change it's going to make to kind of avert a government shutdown for about 3 months. The holdup here is about a bunch of provisions underneath it, and exactly how those land, and also importantly, how this bill gets to be a law by this weekend is the part that's sort of still being worked out. But there's a lot of provisions underneath that will have economic effects. One is about healthcare. It's about pharmacy benefit managers. There's questions about whether there's going to be provisions in there to do that. And there's a whole lot of things in there. There's agriculture money, new trade rules, hurricane relief. A fun one is that there looks like there's going to be a final bill, language in there about RFK Stadium here in Washington to transfer it to DC, which means the Commanders can actually play in Washington as opposed to, Julie, I believe your home state of Maryland, which is where they play now. So the top line here for folks is this change, and it's going to be another government shutdown fight in March. It's going to have Republicans in full control because, of course, they'll take over and have the trifecta. But there'll also be a debt ceiling that'll also be part of that, as well as maybe tax negotiations. So it'll be another fight in March with even more moving parts.
All right, more fights to come. Switching gears, Ben, Senator Elizabeth Warren sending a letter to President-elect Donald Trump today. It was focused on Elon Musk. What can you tell us about that?
Yeah, so this is a new letter from her, and it's about conflict of interest. It kind of arises from the fact that Elon Musk is obviously a very close advisor to Trump. He's heading up this Department of Government Efficiency, but he's not taking a formal governmental role, which means he will not, presumably, they haven't been clear exactly, be subject to conflict of interest rules. And so that's what her letter was about conflict of interest. She called it, I'll read the quote here, it was one of the massive conflict of interest and, quote, an invitation for corruption on a scale not seen in our lifetimes. That's Senator Warren's words. So clearly she's very critical of this and is looking for answers. This is part of a larger story here about exactly how Musk is his ever closening ties to the federal government are gonna work. Sort of how does conflict of interest? We don't really have a sense of that. There was a New York Times report today about how SpaceX is under has been subject to federal reviews, 3 of them, based on sort of disclosures and Elon Musk's security clearance. So there's a whole lot of kind of complex issues here. For their part at the moment, the Trump transition isn't taking it too seriously, nor is Elon Musk. The incoming press secretary offered a statement that basically didn't address Elizabeth Warren's concerns and sort of insulted the senator herself, called her a career politician whose societal impact is, quote, 1/2004 of Elon Musk's. And Elon Musk had sort of dismissive words of his own on X. So it's a big tension point here and how it works out. And it's only going to get more complex as Trump comes into power.
All right, Ben, we'll keep watching. Thank you, sir.
Thanks, guys.
Time now for What to Watch Wednesday, December 18th, sponsored by Tasty Trade. Starting off on the Fed, of course, it's day 2 of the monthly FOMC meeting. Fed's interest rate decision for December is coming out at 2 p.m. Eastern. Fed Chair Jerome Powell is holding a press conference after the decision at 2:30. Most of the market already pricing in a 25 basis point cut tomorrow, but Wall Street will listen closely for any clues about whether the Fed could slow down the pace of rate cuts going into 2025. Yahoo Finance's coverage of the decision will begin at 2 p.m. Eastern.
And we'll get a new dot plot, too. Taking a look at earnings, though, we'll be getting some more earnings tomorrow from Micron, Lennar, and General Mills, among others. Micron will announce results for its first quarter after the close. Analysts expect AI-related demand to help boost revenue for the quarter, with tailwinds from NVIDIA's chip sales.
And moving over to housing, monthly housing starts and building permits data coming out in the morning. Economists forecasting starts to increase to 1.35 million and permits to tick up as well to 1.43 million.
We have an update now on the killing of United Healthcare CEO Brian Thompson. Luigi Mangione was indicted by a grand jury in New York, charged with first-degree murder and 2 counts of murder in the second degree, with one of those counts charging him with killing as an act of terrorism. He's also faced with several charges tied to possession of a weapon, all of which are felonies. Separately, Mangione also faces charges for allegedly possessing an untraceable ghost gun in the state of Pennsylvania. In a news conference, Manhattan District Attorney Alvin Bragg calling the killing a, quote, brazen, targeted, and premeditated shooting. Stay tuned to Yahoo Finance for more updates on that story.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here's some of the trends we're going to be diving into. The Dow dropped another 267 points today. It's the index's first 9-day losing streak since, get this, 1978. We're going to break down the historic funk and try to figure out if an end could be in sight. Then GM is Yahoo Finance's surprise of the year, but could President-elect Donald Trump's plans for the electric vehicle industry keep the legacy automaker stuck in neutral next year? Plus, we're going to talk to the president of one company that could benefit from mysterious drone sightings in the tri-state area. Well, earlier today, Yahoo Finance did name GM its surprise of the year. Here's CEO Mary Barra discussing the company's electric vehicle outlook with our very own Brian Sassi.
You put a real flag in the ground many years ago, Mary, said we're going to be making all electric vehicles by 2035. Is that still your North Star and your hope?
Well, we still have a plan that allows us to get there, and so we're still executing to that plan. But the most important thing, and I've been saying this for a couple of years now, is we're going to be guided by the consumer. We want to give the consumer choice. What do they want to drive? We don't want to get into a situation where, regulations are driving us to force something into the market that's not what they want. But I think once people start to drive an EV, they realize, it's instant torque, beautifully designed. At least General Motors vehicles really give them a lot of technology in the right segments. And then not having to go to the gas station and the benefits of EVs, I think, is something that people are going to move to because it's a better product. What we need to do to accomplish that, though, is to have a robust charging network. And that's what GM Energy is working on with a number of partners.
Of course, the outlook for the industry is cloudy as President-elect Donald Trump is set to take some drastic measures against the sector, including the possibility of ending EV subsidies and taking back federal funding meant for charging infrastructure and more. Joining me now is Aaron Keating, Cox Automotive Executive Analyst. Aaron, it's good to see you. So let's start with this report, which is certainly getting a lot of attention. The Trump transition team recommending changes, cut off support for EVs and charging stations. What do you make of that headline, Aaron? What do you make of that report? Is it what you expected to see?
I mean, we've been expecting to hear from the transition team that they're going to look to cut back some of these benefits that we've seen from the Biden administration. There still remains a lot of questions around how quickly that could actually happen. What are some of the benefits and negatives that the administration is considering? There are some budget reconciliation questions in play of how quickly might they remove some of those EV tax credits. We do expect that the leasing loophole might be one of the first things that they shut down, which would impact EV sales, we do think, leading into after the spring. But we're not exactly sure where this is all going to go. It's certainly something that's been directed towards the car industry, but there's a lot of factors really that need to be considered when we're looking at that.
It's a good point, Aaron. I mean, listen, we're still playing the guessing game here, but I mean, certainly top of mind for investors is the idea, Aaron, that what if Trump does step into the White House and does make changes, including, let's say, rolls back the purchase tax credits. If that were to happen, Aaron, and you try to game out the ripple effects, that would mean what for the U.S. EV market?
Well, first of all, we do actually think that we're going to see an increase in sales between now and certainly the inauguration, if we think that the leasing loophole might go away the first day. There's a lot of people that are out there. There's big demand to get in on those EVs before any tax credit is taken away. It will certainly have an impact. We do see high leasing rates with the vehicles, and that has been helping vehicles sell as well as manufacturer incentives. But we can't forget that we have quite a lot of states that are actually gaining sales in the EVs on their own with their robust state incentives, and those state incentives might not necessarily go away. So we don't think that this is going to directly impact it quickly. We've got 15 new models coming in next year. We think all of these things combined aren't going to see a complete cliff of EV sales, but they certainly would hurt if the leasing loophole was removed quickly.
There's one school of thought of that, Aaron. I'm very interested to get your take on this because it's debated and discussed a lot. If you saw, Trump comes into the White House and we do roll back the purchase tax credit, one school of thought is that actually does help Elon Musk because Tesla has the size, the scale, the cost structure to navigate that efficiently, to keep making money, but it would actually hurt his rivals more. That is debated, but I'm just curious to get your take.
No, at the end of the day, President Trump or incoming President Trump has indicated that he is here for the U.S. business economy. And Tesla is not the only automotive manufacturer that would be impacted by these rules, which is why we think that a lot of this is good conversation to be had, but it won't necessarily be at the detriment of all other automakers. Certainly, Tesla does have profitability built into their model. So far, they've been the leader in EV sales for much longer than the other traditional OEMs. But we've got a lot of new product coming out. We are seeing decent demand from consumers. And I don't know that going away will eradicate other automakers or tank them so significantly that Tesla is the only winner. Tesla continues to lose share to a lot of the other really innovative products that are coming to the market. So it remains to be seen what will actually turn out being his move, and then how that will truly impact all of the other automakers in the market.
And Aaron, finally, we're talking a lot about EVs here, and for good reason, but hybrids have been the place to be. Do you see that trend continuing in 2025?
Absolutely. We see that electrified vehicles, period. We just released our 2025 forecast. We are seeing a robust 2025 year for electrified portfolio, putting around 25%. So ICE vehicles would go to, or internal combustion engine vehicles would go to 75% for the first time ever as far as the mix. So and we think that hybrids, gas hybrids especially, will continue to help lift those numbers.
Aaron, great to have you on the show today. Thanks for joining us. Appreciate it.
Sure.
Well, U.S. stocks closing lower as the Dow extends its losing streak, the longest since 1978. Here with the trading day takeaways, our very own Jared Blickley.
Sad thing is, we were both here for that, but let's get to the market. This is a tale of two markets. Dow might be down 9 days, but guess what? The Nasdaq is near a record high. Did not close at a record high today, but it has been doing that very recently. And I just want to show you the sector action in the month of December. We've had, I believe, 12 days. So there we go. The three in the green. And by the way, this is the S&P 500, so anything greater than that, we're going to say is outperforming. XLY is consumer discretionary. That's a Tesla story. Then we have tech. Tech is a tech story, and communication services is about Alphabet and Meta, but it has been those three sectors that have really gotten the disproportionate share of the gains. And meanwhile, we're still talking about Dow, worst streak since 1978. So what's going on there? Well, I call it sector rotation, and sometimes that's exactly what happens.
What are the pros saying today, Jared? That's what we need to hear from. On a day like this.
What do the pros say? B of A Global Fund Manager Survey. Each month, they go after $500 billion worth of assets in these money managers, and they have a few things to say. I'm not sure where this is coming from here, but there we go, back to the beginning. Sentiment among these people is super bullish. So let me just read you a brief quote. This is from their bottom line of the entire report, just dropped this morning. December Global Fund Managers Survey shows super bullish sentiment. Record low allocation to cash. That's going to be important. Record high allocation to U.S. stocks. 3-year high in global risk appetite driven by Trump 2.0 U.S. growth optimism and also a compliant rate cutting Fed. So the Fed plays a part, Trump plays a part, but they're really just talking about this risk on sentiment. And so you've never had more assets allocated to cash, or at least not in a long time. And you haven't had this much cash come off the sidelines and really been overweight. And that's the key that we're talking about here.
So according to the B of A survey, everything's great. It's dancing bears and rainbows.
So here's a comparison where the cash compares in. And I like the dancing rainbows. Or dancing bears, was it? All right. So the fund manager survey cash allocation fell to 14% underweight from net 4% underweight. So this is the lowest on record. And this goes back to 2001. That's when they started this survey. The 18 percentage point drop in December is the largest monthly decrease in cash allocation in 5 years. Previous lows in the FMS, and that's fund manager survey, cash allocation coincided with big tops in risk assets. That's January to March of 2002, way back when. That was the dot-com bubble busting, and then February of 2011. I looked at these 2 dates, and in 2002, that was in the middle of a big decline there. And I think in general, the cautionary tale from this is when you have so much enthusiasm to get cash off the sidelines that it might just be a mistake. But we'll have to see. This is an immediate timing signal that we're talking about.
We wait and see. Final point.
Final point. This one is going to be easy. Bitcoin over 100,000. And it's taken a while, and yes, we did climb above it last week and maybe the week before, but now it has finally definitively surged above that point. And I'll show you a chart of Bitcoin, and let me just show you the year to date here. There we go, 106,342. It is up 140% year to date. And now you can see over the last, let's put a 10-day chart with some candlesticks here. It was kind of dicey around 100,000. We were poking above it, then dipping down there. We tested 90,000 a couple times. Finally, we're able to rise above. This is what a solid uptrend looks like. And this, by the way, is what a solid longer-term uptrend looks like.
So since the election, I'm curious, what's up the most in the world of crypto?
Yeah, let's see. So I'm going to put a 2-month chart just to cover all our bases here. It's going to be a little bit more, but we see XRP Ripple up 381.7% over these last 2 months. Here's a 2-year chart, and you can see it's kind of a hockey stick right now, but a lot of these crypto charts look that way.
Jared,
That's it.
Thank you, my friend. Appreciate it. More Ask You for a Trend right on the other side. Mysterious drone sightings in the tri-state area placing a bright spotlight on public safety stocks such as Axon, but that is not the only buzz around this company as it gears up to join the Nasdaq 100. And Axon President Josh Isner joins us now to discuss. Josh, it is great to have you on the show. So let's start right there. Big news for you all. You're going to join the Nasdaq 100, of course, which is tracked by a number of investment funds. Josh, walk us through that milestone. What does it mean for your company?
Yeah, first of all, thanks for having me on, Josh. I appreciate your time. And ultimately, it's a great milestone for the company. It's a great sign of external validation for all the work we've put in over the years. But at Axon, we measure our success in terms of life saved. Our mission is to protect life. We deploy tools into public safety that lead to safer outcomes between police and civilians. And our job is to cut deaths in policing by 50% in the next 10 years. We call that our moonshot goal. And that's really what we're focused on. And when we do that well and support our customers, the rest seems to take care of itself.
You know, I was talking, Josh, to an analyst who covers you all today, and he was saying how one theory for the company right now is that Trump moving back into the White House is just good news for these guys. They will benefit in a good way. In fact, you know, you are the second best performing name right now, Josh, in the S&P since the election. So Trump moving back into the White House, walk me through what you think the impact, the ripple effects of that could be.
Sure thing. And the first thing I'll say, Josh, is we try to run our company apolitically. We're here to serve the United States government however we can. We've had success under candidates from both parties. In this case, with the Trump administration coming back, certainly they've been very vocal about the fact that the police need to be refunded, that they're going to be investing in a more secure border. And we're happy to hear that, because not only do we agree, but we think we can really help there. So we're standing by and ready to partner again to see how we can lead to some safer outcomes in the field for everyone.
And you do, Josh. I mean, listen, you want to grow that federal business, of course. I mean, bottom line, having Trump back in the White House, is that a tailwind for that business?
I think you could consider it a tailwind, no matter, which party is saying it. When the party coming into the executive branch is saying, look, funding the police and funding the Customs and Border Protection and other elements of the federal government's security apparatus, of course, yeah, we would look at that as something that we're very eager to help with, and we would consider that a tailwind.
Josh, let's turn to the financials, because when you reported your Q3 in November, you were talking about bookings, and you said the sum of just Q3 and Q4 this year would be comparable to what you did all of last year. That is a lot of confidence, Josh. I'm curious what gave you that confidence and how you're doing in meeting that goal.
Look, confidence is part of our DNA at Axon. We talk about our identity as a team. We're big on team sports references. And at Axon, we say we're a winning team with a lot of swagger that delivers outsized societal outcomes. And we really believe that, and we're seeing that. And we're excited about where we're at in the quarter and in the year here. We still have a lot of work to do and business to close over the next week or so, but we're very bullish on the company's future, and we see the increased demand as a very positive sign to suggest that what we're building, the products between hardware and software, really do have product market fit in this market and are providing a lot of value to our customers.
Josh, let's also talk about drones, because you all have a drone presence. I got to ask you, I mean, these reports of drones in New York, New Jersey, lots of reports, rumors, speculation. I'm curious to get your take, Josh. What do you think is actually happening out there?
Last night I heard the press conference where it was suggested that these are not, malicious, bad acting drones. And so, certainly we're hopeful that that's the case. I think, taking a step back, we acquired a company called D-Drone earlier this year. The acquisition closed on October 1st. And we kind of saw this coming, that drone awareness and mitigation was going to be a part of the future of public safety. You see what's happening in Ukraine with drones playing a large part in warfighting, and being able to track drones, identify what type of drone they are, identify where the pilot is, and ultimately having the ability to mitigate those drones if they are a threat is going to be very important. And we feel very well positioned via this acquisition to help in that way.
You're going where I hope to go, Josh, which is I do see analysts saying, listen, one theme they expect over the next 5-10 years, they do believe you're going to see this surge in spending on counter-drone technology by government agencies, both local and state. You believe you all are well positioned to leverage and capitalize on that trend?
Absolutely. Absolutely. We've seen this coming for a long time. We were a channel partner of D-Drones for a number of years before we ultimately made the decision and came to an agreement to acquire them. But absolutely, this is going to be a major part of policing and drones in general as a category, whether it's counter drone or deploying drones to promote more safe use cases. I think is absolutely going to be very, very relevant for the years to come in policing.
Josh, great to have you on the show today. Thanks so much for taking the time to join us. We appreciate it.
Thank you very much, Josh. I appreciate it.
Stick around. Much more Asking for a Trend still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains, where for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're taking a look at what history could tell us about how stocks will do next year with today's chart of the day. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
And Josh, this chart coming to us from Savita Subramanian of Bank of America, who we talked to at the top of the 3 p.m. Now, she and many of the other strategists on the street are looking for gains next year, but not huge gains. In her case, called 10, 11% gains. Why not larger? Well, history is one reason, although she sort of downplayed history as a reason. But nonetheless, it's interesting to look at here. So this chart looks at how stocks, specifically the S&P 500, has done in the 12 months following a 40 to 50% two-year run versus all the time, right? Going back, just average return for the S&P 500. So the average return for the S&P 500, most commonly here, at a little over 20%, is 10 to 20%. If you go back on average, that's how much the S&P 500 returns in a year. However, after a 40 to 50% two-year run, that gets smaller, a gain of about 0 to 10%, according to the historical research. In other words, after a big two-year run, stocks are less likely to gain at all. They go negative here. And less likely to continue that magnitude of momentum than overall gains over the course of time. So after this run that we have had in the S&P 500 over the past couple of years, it is less likely that we will continue to see gains of over 10% certainly, but even gains at all if you look at history. Now, Savita did caution us to rely too heavily on history. After all, she said, if you look at the S&P 500 today, it's very different, say, than the S&P 500 composition of 1980, where it was much more industrially focused, less tech, et cetera. Nonetheless, again, it's still fun, it's still interesting to look at what we have seen over the course of history.
And Savita telling us her own year-end 2025 target, implying potentially about 11% upside. Not too shabby, Julie.
Yeah.
All right, that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.